Hi, I'm Jessica Amir for the Finance News Network. Joining me from VanEck Australia is its Director of Investments, Russel Chesler. Hi Russell, welcome to the network.
Hi Jessica, great to be here today.
Well, thanks for coming. First up, just tell us about VanEck Australia and the Australian Equal Weight ETF.
VanEck is a global asset manager and we've been around since 1955. We're one of the largest providers globally of exchange-traded funds, or they're commonly referred to as ETFs. We currently offer over 75 exchange-traded funds, including 15 which are listed on the ASX. The VanEck Vectors Australian Equal Weight ETF, which is listed under the code MVW, is our core equity strategy and has over $400 million in assets. It is the first of its kind in Australia, and this year won Money Magazine's Best Australian Equity ETF. MVW weights the largest and most liquid stocks on the ASX equally and provides investors with access to a portfolio which represents the broad Australian economy and not just the top 10 companies in the ASX. We currently have 81 companies in the ETF, and they're each equally weighted at 1.25%.
Russell, can you just tell us what is the concept behind having an equal weighted ETF?
Well, if we start off looking at the current market, where ETFs have historically been, they've generally tracked a market capitalization index like the ASX 200. Now, part of the problem with an index like the ASX 200 is that it weights each stock by size. And this can result in unintended and significant concentration risk, both at a sector level and at a stock level. If we take the ASX 200, the top 10 companies in the index make up 45% of that index. That includes the banks and the likes of BHP. The ASX 200 has 40% in financials. Now, if we come to equal weight strategy, which is fairly easy to understand, it mitigates that stock and sector concentration risk. So with CBA, we only have about 1.25% invested in CBA compared to the ASX 200, which is over 8%. Financials, we're down to about 16-17% compared to 35% overall. So you're getting a much more diversified portfolio. Equal weighting not only improves diversification and reduces concentration risk, but also produces better performance results.
So how has the fund performed over the past 12 months?
So the fund over the last 12 months achieved a return of 13.6%. That's to the 28th of February, and that's 3.5% ahead of the ASX 200. The fund pays distributions twice a year, and the investors receive the franking credits from the underlying stocks as well.
And how often is the fund re-weighted to account for price movement?
The fund is re-weighted on a quarterly basis back to equal weight. So what happens at that point is stocks which have been winners are basically sold down, the poor performers are bought up. A good example of where that contributed really positively to the performance was Qantas. It had been performing poorly, we brought it back up to equal weight, and then the performance came through afterwards.
Russell, the ETF trades under the ticker code MVW. How can people get involved and what's the liquidity like?
People can invest in MVW through their broker or through their financial planner, just like any other stock on the ASX. MVW, because it is reasonably large at 400 million, it has good liquidity and is also supported by a range of market makers who ensure deep volume and a really tight bid-ask spread.
And the ETF, the Australian Equal Weight ETF, is the only of its kind in Australia, but what's the situation like overseas?
Well, equal weighting is not a new concept. It has been around for a long time. VanEck was the first to launch an equal weight in the form of an ETF in Australia. If we look to the US and Europe, which are far larger markets, equal weight ETFs have been around for nearly 15 years now. There is numerous research, both locally and globally, into equal weighting. Our own CSIRO, in conjunction with Monash University, conducted extensive research and concluded that equal weight outperforms market capitalization indices for three key reasons. Firstly, higher exposure to smaller stocks rather than bigger stocks. Secondly, higher exposure to value stocks. And lastly, better market timing. Tends to perform better in rising markets and less poorly in falling markets.
And Russell, what's your parting message to investors today?
Well, MVW provides investors with access to a diversified portfolio of equally weighted stocks in a single trade. The fees for MVW are 1/3 of that charged by actively managed Australian equity funds, and the returns have been impressive. It gives you exposure to the broader Australian economy and is backed by one of the world's largest and longest standing ETF providers, VanEck.
And well done on your outperformance. Russel Chesler, thank you so much for the update.
Thank you for having me today, Jessica.